I'm going to show you the different ways to analyze a property to see if it's a good deal or not. These formulas are going to be so easy that you won't need any spreadsheets or calculators or your iPhone. In fact, I'm going to go through all the ways to analyze a property using just my pen and my notepad. So let's talk about why do you need to analyze a property deal in the first place. It's quite simple really, and it's to see if it's a good deal or not. Are you going to make money or lose money? If so, how much? What gets measured gets managed. So if you're able to analyze a property deal properly, you're going to make a lot of money over time, because money is made when buying a property, not selling. And in my opinion, analyzing a property is one of the most important things you can do as a property investor. The formulas I'm going to go through each tell a different story. I'm going to show you what they are and how they work, and after that it's up to you to figure out which ones you need or not. Now, most people I speak to, they want to get into property to replace their 9-to-5 incomes or earn an additional passive income. So they want to build wealth that they can live off. In property, you make money in two ways. One from the income it produces every month, right? And the other one is from the capital appreciation that happens over many years. All the formulas I'm going to discuss are related to the first method, which is analyzing the property based on the rental income.
We'll get back to the video in a few seconds, but 70% of you watching this video aren't subscribed to my channel. Please do me a favor and hit the subscribe button and buy more properties in the next few months. I'll be sharing everything so you can learn from my mistakes for free. Anyways, back to the video.
So let's get started with probably the most common method, which is yield. And yield, it's pretty simple to calculate. The first step is to get your monthly rental income, okay? And you essentially times it by 12, which then gives you your annual rental income, okay? And then once you find your annual rental income, all you do is you then divide that by the purchase price, right? And then times it by 100 to give you a gross yield percentage. So let's go through an example, right? And so let's say you purchased a property, or you're about to purchase a property for £120,000, right? And the monthly rental value or monthly rent on that property is £1,000 a month, which gives you an annual rent of £12,000. So the way you get the annual rent is you basically just times that £1,000 by 12, okay, which will give you the annual rent. Straightforward, okay? So to calculate the yield, what you would now need to do, you've got the annual rent, so you just get 12,000 and you divide it by the £120,000 purchase price, okay, which is going to give you, and then you just times that, which is going to give you, and you times that by 100, sorry, and all in all, that's going to give you 10% gross rental yield. So when would you actually use yield? Really, it's when the specific costs of owning a property aren't really known. That's why you'll notice that a lot of lenders, when considering the affordability of buy-to-let mortgages and even estate agents, they use yield as a bit of a yardstick to see if it's a good investment or not. And that's why you'll see on websites like Rightmove, Zoopla, that some listings will mention stuff like potential 6% yield, or suitable for property investors at a 6% yield or something like that, or high yielding property. You get the idea. In reality though, yield doesn't tell you the full story, because it doesn't take into account the costs and fees that come with owning a property, but as a quick snapshot, it works. So the next one is the 1% rule, which I came across from Bigger Pockets in the US, and I've now started to use this myself. This formula, it quickly gives you an idea of the minimum monthly rent you must charge to break even on a property, and you tend to use this very early on in the deal analysis stage. But it basically means that the monthly gross rent of the property should be greater than or equal to 1% of the total purchase price. So let me repeat that again. The 1% rule basically means that the monthly gross rent should be greater than or equal to 1% of the total purchase price. So here's an example of a property that would meet the 1% rule, right? Let's say you've got a property that rents out for £2,000 a month, and the property is on the market for £190,000. So to calculate 1% of 1900, all you do is you just move the decimal place to two places. So that's 1, that's 2, that gives you £1,900. Okay, the rent we know is already £2,000, which is obviously greater than £1,900, and this effectively means that it does meet the 1% rule. So essentially what you can see is this particular property does meet the 1% rule, but if this, for example, now let's just go back. If this, for example, the rent, instead of £2,000, it was, let's say it was 1,800, okay? So that would mean it obviously wouldn't meet the 1% rule because £1,900 is greater than £1,800. Now, a lot of people think that this 1% rule formula is outdated, and if you're basing your investment strategy solely on the 1% rule, you'll end up missing out on many potential great investments with rent to price ratios below the 1%. So this is where focusing on the third metric could be a better alternative, which is cash flow. So as an example, let's say you rent a property out for £2,000 a month, and all of your monthly costs such as your mortgage payment, your insurance, property management fees, and any budget kept aside for voids and maintenance, all of those costs add up to £1,500. Then your cash flow is £500 a month positive, right? And just note that your cash flow doesn't take into account stuff like your taxes and that. This is your monthly cost that we're talking about, which is used to deduct from your rental income to work out your cash flow. Now, cash flow is a simple but important number. If your cash flow is negative, you won't be able to pay your bills or make a profit, right? You're not going to be making any money, at least in terms of the income side of things. Negative cash flow could also indicate that either your rents are too low, or in most cases your expenses are too high. So it gives you an opportunity to properly examine all your outgoings. Cash flow can tell you how much money you make monthly, but this knowledge, it only gets you so far. The next formula I want to talk about to analyze your property income is return on investment, or ROI. The simplest explanation for return on investment is how much money you're earning off your total cash invested. ROI is an important metric because unlike other investing metrics, it also includes your other costs, right? Like your mortgage and insurance, similar to cash flow, but it also takes into consideration how much of your own money you've put down into the property. So to work out the return on investment, right, the first thing you got to do is take your monthly cash flow and times it by 12. Okay, that will give you your annual cash flow. You've got the annual cash flow. Then get your total money invested figure. So that will include everything like your 25% deposit, your stamp duty, legal fees, broker fees, everything, right? Everything that you put into. So that's your total money invested. And then the final thing, step 3, is take your annual cash flow, right, and divide it by total money invested, and then times that by 100, which will then give you your return on investment. So just to repeat, it's your annual cash flow divided by total money invested, and then you times that figure by 100 to get a return on investment as a percentage. So using the previous example, okay, of £500 a month in cash flow, if you just times that by 12, okay, that will give you £6,000 in annual cash flow. And then let's say to purchase that property you had to put down £50,000, right, excluding any bank loans. So your total money invested is £50,000. What you do is then you just take the £6,000 and you divide it by the £50,000, which works out to 0.12, and then what you do, you multiply that by 100, remember, and then that will give you a 12% ROI. What makes a good return on investment is personal, right? But just remember that the return on investment is based on the money you make on your property income. It doesn't take into account any appreciation or capital growth. So personally, I'm happy with a 15 to 20% ROI on the properties which I buy, which is what I normally aim for and tend to usually get. If I can get more, great, right? I'm not going to say no to it, but just remember that the higher ROI you start looking for, naturally there will be fewer and fewer of those options. And the last thing you want to do is be missing out on a 40% ROI, for example, just because you're only looking for 60% ROI deals, because let's be honest, 40% ROI is still a good return, right? So is 30%, so is 20% in my opinion. So you get the idea. The final formula is the rule of 72. This is such a simple but pretty cool formula which basically tells you you how long it's going to take to double your money based on the return on investment you're going to get, right? So all you have to do is take the number 72, okay, and you divide it by the expected return on investment, and it'll tell you how many years it will take for the initial investment to duplicate itself. So for example, here's the number 72, okay, divided by the 12% return on investment we just worked out, okay, that will give you 6, which means it will take you 6 years for you to double your investment if the return on investment was 12% each year. Needless to say, the quicker it takes you to double your money, the better the investment, right? Which basically means, so if you were to, let's say, get an 18% return on investment, let's draw that out, yeah, and you divide that by 72, that would be 4 instead of 6 years, okay? So naturally, that's going to take a lot quicker to double your money. Those 5 formulas are essentially how to analyze a property deal without having to use all these fancy spreadsheets, these calculators, your iPhone. You just need a pen and paper or a notepad like I've got and work your way. Just remember though, guys, that these 5 formulas we've just talked about, they should only be used as a quick back of the envelope calculation to quickly assess whether a deal is worth investigating further, right? When it comes to investing, speed is key, and hopefully you now have a better idea of how to go about analyzing deals quickly. But in the end, before purchasing a property and committing thousands of pounds off your hard-earned money to it, right, it's always recommended to use a software or a spreadsheet that will help you analyze a property in full. Don't avoid the fundamentals, guys, and analyzing a property deal is fundamental. And if you want to know more about the things you should avoid in property apart from the fundamentals, I'm going to put up a video on the side here called Avoid These Property Mistakes at All Costs. Go watch that video after this one, and I'll see you soon.